Rahim. This is the third video on forecasting financial statements. And in this video, we will solve exercises on how to compute the amount of dividends the company can assume that it will pay in order to balance their projected balance sheet. We will solve an exercise on identifying the cost structure. We will also solve an exercise on smoothing changes in accounts receivable. And finally, we will solve an exercise on smoothing changes in inventories. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us solve an exercise on how to compute the amount of dividends the company can assume to pay in order to balance their projected balance sheet. The following data for Squad's company represent a summary of your first iteration forecast amounts for year number 1. Squads uses dividends as a flexible financial account. Compute the amount of dividends you can assume that Squads will pay in order to balance your projected balance sheet. Present the projected balance sheet. So in this exercise, we will compute the plug to dividends to balance the balance sheet for Squad's company for year number 1. I will upload a separate video on plugging dividends for those who want to know more about it. But in brief, plugging dividends means calculating exact amount of dividend that should be paid to ensure that the balance sheet is balanced correctly. This process involves adjusting the dividend payments to ensure the accounting equation assets is equal to liabilities plus stockholder equity holds true after accounting for net income and other changes. And let us see how this is going to be done. Now for year number 1, the balance sheet amount before plugging, we have the total assets of 200. Then we have the accrued liabilities, long-term debt, common stock, and the beginning retained earning. So obviously we have the so if we are going to prepare the accounting, if we place these values in the accounting equation, assets are equal to 200 and the liabilities are 43 plus 80, that is 123, and the common stock is 20 over here, and the beginning we have only the beginning retained earning of 34. To this we are going to add the net income, and obviously we do not know how much is the ending retained earning. So if we make the total, this is 200 is equal to 143 plus 74, that is equal to 217, and this means that the equation is not balanced. So we have to, it is necessary to plug to increase the dividend to balance the balance sheet, and the difference of 17, let us see how we are going to plug in. Now the total assets will remain 200 definitely. We have the assets as 200, and then we have the liabilities And under the liabilities, we have accrued liability of 43. We have long-term debt of 80. We have common stock of 20. And now the ending retained earning, because we have to plug in that $17 of dividend, that means 74 minus 17, that is equal to 57. And now if we make the total is equal to 200. That's how we are going to this is what the amount of dividend the company must pay for their forecasted next year. Yeah, and obviously now you can see that the projected balance sheet is balanced. Next, let us see how to identify the cost structure. And let us see over here. Now, Sony Corporation manufactures and markets consumer electronic products. Assume the following are selected income statement data for the year 2014 and 2015, and we are required to estimate the variable cost as a percentage of sales for the cost of goods sold by dividing the amount of the change in the cost of goods sold by the amount of the change in sales. Then we will multiply the variable cost percentage times sales to estimate the total variable cost. So we need to know the change in the cost of goods sold. We are going to look into the cost change in the sales. Now subtract the variable cost and we have to determine the variable cost as well. Variable cost from the total cost to estimate the fixed cost. So we need to know the fixed cost as well. Following this procedure to determine the cost structure, fixed cost plus variable cost as a percentage of sales for cost of goods sold for Sony. So let us first of all go for the whole process, and the first one is the change in the cost of goods sold, and the change in the cost of goods sold will be we are going to calculate as um, and this will be how much? We have the 5257, the cost of goods in the year 2015, 5257, and because we are talking about change, so we have to subtract the cost of goods sold in the year 2014, that is 5140, and the difference is equal to 135. Then we look into the change in sales, and the change in now the sales is for the year 2015 is 7036, 7036, and we are going to subtract this from 6682, that is the sales for the previous year, and this will be equal to 354. Next, we are going to determine the variable cost percentage, and the variable cost percentage will be equal to the change in the cost of goods sold, and that is 135, and this will be divided by the change in sales, that is 354, and this will be equal to 0.381. So that is the variable cost percentage, 0.381. Now we calculate the fixed cost for the year 2014 first of all, and for the fixed cost for 2014 we have the We have the cost of goods sold for 2014 as 5140. So 5140, and this will be, from this we are going to subtract the we are going to subtract the cost, the from this the variable cost, and that is 0.381 0.381 times the sales of 2014, that is 6682, and this will be equal to 2591.78. Now because the fixed cost is the cost that remains fixed, so even for the year 2015 it will be the same amount, that is 2591.78, as there is no other information given to us. And we can also calculate, you can see that for the year 2015 we have the cost of goods sold as 5275 minus the same again, that is a variable cost percentage 0.381 times the sales of 2015, that is 7036, and if you are going to simplify you will get the same amount over here again. So that's how we are going to calculate uh, the 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 required information. For the cost structure, we have the change in the cost of goods sold, change in sales, variable cost percentage, and the fixed cost. We go to part B, and this is part B, and this is part A. Repeat requirement A, that is requirement A is what we are talking here about, the cost of goods sold, change in sales, variable cost, and the fixed cost for 2014 and 15. And this time we are not going to talk about the total variable cost or the fixed cost, rather we are going to be more specific, and we want to calculate for selling and administrative expenses. So let me clean up this part first of all. Rather I will keep it for we can clean up. Okay. Now the change in let us see how we are going to determine the change in the selling and administrative expenses. So we can see that the selling and administrative expenses for the year 2015 was 1811, and from this we are going to subtract the sales of selling and administrative expenses for the year 2014, that is 1729, and this is equal to 82. The change in sales from requirement A, this was already calculated before, that was 354, if you can remember, that is the 7036 minus 6682, that is 354. Now we calculate the variable cost percentage, and the variable cost percentage will be the change in the selling and administrative expenses, that is 82 divided by the change in sales, that is 354, and this will give us 0.232. Next, we are going to determine the fixed cost, and obviously for both the years there is no additional information regarding fixed cost, so it will be the same. But for, let us see how we calculate for the year 2014. First of all, the selling and administrative expenses are 1729 minus the variable cost percentage, that is 0.232 multiplied by uh, the sales of 2014, that is 6682, and this will be equal to how much? This will be equal to 181.19. For the year 2015, we are going to have now the for the year 2015 the selling and administrative expenses are 1811 and 1811, and here it was for 2014 it was 6682. Sorry, selling 1729. The selling and administrative expenses for 2014 was 1729, and for 2015 it is 1811, and once again minus the variable cost percentage, that is 0.232 times the sales for 2015, and that is 7036, and this is equal to, you can see, 181.19. Okay, so we have done part A and we have done part B. Was part A and this was part B, and we move on to part C of the same exercise. Now suppose that Sony Corporation discloses that it expects its sales to grow at the following rates in future years: 1, 2, 3, and 4. So we have to compute the ratio as well. So first of all, we go for the required information, and we have to project the sales. We have to project the cost of goods sold, fixed and variable both, and we have to go for the selling and administrative expenses, fixed and variable, and the operating income before income taxes. So first of all, let us look into the sales. Now the sales for the year 2015 was 7036. It was 7036, and the increase in sales is going to be by 12%. That means multiplied by 1.12, that will be equal to 7036 times 1.12, that is equal to 7880.32. In the same way, you can calculate for year 2, 3, and 4, and this will be 8668.35. This will be 9361.82 and 9923.53. Then we go for the cost of goods sold, and for the cost of goods sold we have already calculated before the cost of goods sold. And if you can remember, the cost of goods sold was calculated here. That is, I can just quickly go back again. The cost of goods sold for the fixed part, for the year 2014 was 5140, minus, if you can remember, recall, we have the changes in the cost of goods sold as 135, that is 5725 minus 5140, and then the change in the sales was 6687036 minus 6682, that was 354. So the variable cost percentage was 135 divided by 354, that is 0.381. So we have now we have, for the fixed cost, we have the cost of goods sold 5140 minus the variable cost percentage, that is 0.381, and this will be multiplied by 6682, that is the sale of the year 2014, and that is 6682, and this will be equal to 2591.78. So this is the fixed cost for the year 2014, and it will not change for 2015 as well. So let us jump back to what we were solving. So we have the sales, and now we have the cost of goods sold. Now for cost of goods sold, that is what we have calculated here, 2591.78. So it is not going to change, 2591.78, and this will be the same for all the 4 years. Then the variable cost that we have just now seen, it was 0.381. So we are going to have the variable cost is 0.381 of sales. So 0.381 times 788, and the sales, that is equal to 3005.21. For the second year, it will be 3305.73. It will be 3570.19 and 3784.40. Then we go for the selling and administrative expenses. For the fixed, again we have the selling and administrative expenses as 181.9, so they are not going to change, 181.19, and they will not change as they are fixed. And the variable cost that we have calculated over here was 0.232. So once again, because variable cost times sales, so this will be 1825.38, 2007.92, 2168.56, and 2298.67. Next, we are going to calculate the operating income before income taxes, and this will be sales minus cost, both fixed and variable. So the operating income before income tax will be 276.76 for year number 1, 581.73, 850.11, and 1067.49. Next we go to part D, and we have to compute the ratio of operating income before income taxes to sales for year 1 through 4. So obviously we have the operating income. We will divide this by sales, and this is equal to 3.51%. This is 6.71%, 9.08%, and 10.76%. So this was part C, and this was part number D. We go to part E now, finally, and that is interpret the changes in the ratio computed in requirement number D in light of the expected changes in sales. So we can see that the percentage of operating income before income taxes to sales, often referred to as operating income margin, is increasing over time for the Sony Corporation. You can see it is increasing, showing an increasing trend. So this increase occurs because Sony is able to spread its fixed operating cost over a larger sales volume. So fixed costs are expenses, that do not change with the level of sales or production, such as rent, salaries, depreciation, etc. And as sales grow, the same fixed cost are allocated across more units of sales. So this reduces the fixed cost per unit, which can enhance the operating income margin if other factors remain constant. Essentially, Sony benefits from economies of scale where increased sales lead to a lower average cost per unit, improving profitability. Now, while the operating income percentage is rising, you can see this metric alone doesn't capture the complete picture of Sony's profitability. The sales growth, even though are projected to increase, you can see over here that they are increasing, uh, uh, but if you look at the growth rate is continuously decreasing. So this means that Sony's revenue are still rising. The rate of this increase is slowing down. So if the sales grow by 20% last year but are expected to grow by only 10% this year, so the rate of growth has slowed. So given the decreasing growth rate, Sony might need to make strategic adjustments to maintain or improve profitability. Sony can consider adjusting its selling price to counteract slower growth. The company might increase prices to maintain revenue levels or profitability, though this could impact sales volume. Sony could look to reduce manufacturing costs through efficiency improvements, cost cutting measures, or technological advancements. Lower production cost can help sustain profitability despite slower sales growth. The company might also adjust its selling and administrative expenses. Reducing these costs or improving operational efficiency can help offset the impact of slower sales growth on overall profitability. So if Sony adjusts its selling price, manufacturing cost, or selling and administrative cost in response to the declining rate of sales growth, the overall cost structure will change. So changes in any of these areas would alter the balance between fixed and variable cost, potentially impacting the operating income margin. For example, increasing selling price could lead to higher margins, while reducing cost could improve profitability. As a result, the cost structure used in previous calculations would need to be updated to reflect these adjustments. This means recalculating the operating income percentage and other financial metrics based on the revised cost structure. So, in summary, while Sony's increasing operating income percentage indicates improved profitability from spreading fixed cost over a larger sales volume, The decreasing growth rate of sales suggests that the company will need to make strategic adjustments to its pricing, manufacturing, and administrative strategies. These adjustments will impact the overall cost structure and should be reflected in future financial analysis. Next, let us solve an exercise on smoothing changes in accounts receivable. Now, Hasbro designed, manufactures, and markets toys and games for children and adults in the United States and in international markets. Hasbro's portfolio of brand and products contains some of the most well known toys and games under famous brands such as Playcool, Tonka Trucks, Milton Bradley, and Parker Brothers, and includes such classic games as Scrabble, Monopoly, and Clue. Now, assume that sales during 2015 totaled, so we have sales for 2015 4448 million. Also assume that account receivable total 1095 million. The accounts receivable at the beginning of 2014 and 1218 million at the end of 2015. So we are required use the average balance to compute the account receivable turnover ratio for Hasbro for the year 2015. So first of all, let us calculate the average balance. So, and that is the accounts receivable turnover. So accounts receivable turnover, this will be equal to the sales of 2015, and that was 448 million. 4,448 million divided by average accounts receivable, and the average accounts receivable is 1095 plus 1218. 1095 plus 1218 divided by 2, because we have to take the average. So this will be equal to 3.85. So the accounts receivable turnover is 3.85. Now, part B, assume that Hasbro sales will grow at a 13% rate each year for year 1 through 5, and that the account receivable turnover ratio each year will equal the ratio computed in requirement A, that is 3.85. Project the amount of accounts receivable at year end through year 5 based on the account receivable turnover computed in requirement A. Also compute the percentage change in accounts receivable between each of the year ends through year 5. Okay. So first of all, we have to calculate the sales, and the sales for the year 2015. Sales for 2015 was 4448, and what we can see is the sales is going to grow at the rate of 13%, so times 1.13, and this will be equal to 4448 times 1.13, and that is equal to 5026.24. And because it is increasing at the rate of 13% each year, so we can calculate the same way as 5026.24.1.13, that is 5679.65. This will be 6418.01, 7252.35, and 8195.15. Now, account receivable turnover, we have already calculated 3.85, and this will remain the same for all the years. Now, the accounts receivable at the end of 2015 is 1218. That means the same amount will be the beginning and inventory for the year, for the next year, that is 1218. And now we are going to calculate the account receivable at the end of the year. So let us calculate over here. Now for this we will take the sales of year 1, that is 5026.24, divided by account receivable turnover, and that is 3.85. So 3.85, and we are going to subtract this amount from this, the beginning inventory, that is 1218, and this will be equal to, this will be equal to 1218 this will be equal to 87, and we will multiply this by accounts receivable turnover. $5026.24, that is the sales, and we will divide this by average accounts receivable turnover. So we have this was 3.85 divided by 2, that is equal to 1. So this will be 5026.24 divided by 1.925, 3.85 divided by 2. So 5026.24 divided by 1.925, that is 2611.03, and from this we are going to subtract the beginning inventory, that is 1218, and this is equal to 1395.63. So, oh, sorry, 1395.69. And then if we want to calculate the average accounts receivable, it is beginning of the year plus ending of the year, that is 1218 plus 1395.69, and this will be divided by 2, that is 1306.85. Then we have the percentage change in accounts receivable. So the percentage change will be account receivable at the end of the period, that is 1395.69, minus beginning of accounts receivable, that is 1218, divided by 1218 again. So 1395.69 minus 1218, this is 177.69 divided by 1218, and that is equal to 14.59%. So now I just for your information, the end account receivable at the end of the year will be the beginning account receivable for the beginning of the year, for beginning of the next year, that is 1395.69, And in the same way, we are going to calculate the end of the year, that is sales for year number 2 divided by account receivable, average account receivable turnover. That average means 3.85 divided by 2 and minus 1395.69, and that will give us 1557.78, and the percentage change will be the same, 1557.78 minus 1395.69 divided by 1395.69, that is 11.61%. And the average, obviously beginning plus ending divided by 2, so that will be 1476.73. In the same way, we will calculate for the, now this is going to be the beginning now, 1557.78. The ending will be 1779.64, and the percentage change will be 14.24%. Then for the year number 4, it will be once again 1779.64, and this will be 1991.64, and this is 11.91%. And 1991.64 to 69.91, and the percentage change will be 13.97%. For the average, again beginning plus ending divided by 2, this will be 1668.71, 1885.64, the 2130.78. Okay, so we go to number C. Does the pattern of growth in your projection of Hasbro's accounts receivable seem reasonable considering the assumptions of smooth growth in sales and steady turnover? And we have to explain. Now, if we look into this, the observed sawtooth pattern in receivables is indicative of irregular fluctuations in the receivables balance over time, which deviates from the expected smooth growth in sales and consistent accounts receivable turnover. This pattern appears inconsistent with the assumptions of stable and steady financial metrics. A sawtooth pattern in receivables typically involves a series of sharp increases and decreases rather than a steady or smooth trend. In the context of receivables, this pattern is often a result of periodic anomalies or imbalances in the receivables balance. The root cause of the sawtooth pattern in this scenario is the slightly lower than average receivable balance recorded in the year 2015. And this imbalance affects obviously the subsequent years. The receivable balance in 2015 was lower than the average, creating a deficit relative to what would be expected based on the company's normal sales and credit policies. To correct for this lower balance, there is a compensatory adjustment in year 1 where the receivable balance increases significantly, as you can see. This compensatory increase is necessary to align the receivables with the expected levels based on the company's sales and credit turnover rates. So this pattern of compensation continues in subsequent years. You can see year number 2, 3, and 4. And each year experiences a similar pattern of unusually large changes in receivables oscillating between higher and lower balances. And this is because the initial imbalance creates a ripple effect, causing each subsequent year to adjust in response to the previous year discrepancies. The sawtooth pattern contradicts the expected smooth growth and steady turnover ratios. Normally, a company with stable sale growth and consistent accounts receivable turnover would exhibit a more regular and predictable trend in receivables. The irregularities in the receivables pattern suggest that there might be underlying issues or anomalies in the company's receivables management or financial reporting. These could include issues with credit policies, seasonal sales fluctuations, or errors in recording. So, in summary, the sawtooth pattern in receivable arises from an initial imbalance in the receivable balance in 2015, leading to compensatory adjustments in the following years. This irregularity disrupts the expected smooth trend and highlights the need for further analysis to address and understand the underlying causes. Okay, now we have done A, B, and C. Yes, and now we move on to part D of the same exercise on this slide. Now, the changes in accounts receivable computed in requirement B display a sawtooth pattern. Smooth the changes in account receivables by computing the year-end accounts receivable balance for year 1 through 5 using the compound annual growth rate in accounts receivable between the end of 2015 and the end of year 1 from requirement B. Okay, so first of all, we are going to determine the compound annual growth rate, and so the compound annual growth rate will be the account receivable at the beginning of the year number 5 and account receivable, sorry, at the end of year number 5. And for year number 5 it was how much? It was 2269.91. So we have 2269.91, and this will be divided by account receivable at the beginning of year number 1, and the beginning year number 1 it was 1218. 1218. Now the period, the number of years is 5, so this will be to the power 1 over 5 minus 1, and this will be equal to 1.1322. Sorry, this will be equal to 13.22%. So the annual compounded annual growth rate is 13.22. So we will now the beginning account receivable in year number 1 was 1218, as you can see here, 1218, and the growth rate is 13.22, that means 1.1322. so the ending account receivable will be 1218 times 1.1322, that is 1379.02. Now the ending account receivable for year number 1 will be the beginning account receivable for year number 2, what is 1379.02 times once again 1.1322, 1322, this will not change, and this is equal to, so this will be 1561.33, and this will be the beginning for the next year, 1561.33, and 1767.73, 1767.73, and this will be 2001.43, and this will be 2266.02. So that's how we are going to calculate the beginning and ending. And now they are asking for part E. Smooth the changes in accounts receivable using the compound annual growth rate in account receivable between the end of 2015 and the end of year plus 4. Okay, so now we will have all the same information. There will except that for the when we calculate the compound annual growth rate, and that is equal to the account receivable at the end of year number 4 and not year number 5. So year number 4, as you can see, what is 199.64. So 1991.64 divided by the beginning, that is 1218 for year number 1, 1218, and now this is for a period of 4 years, that's so the t power 1 upon 4 minus 1, and this will be equal to now 13.07%. So now the growth rate will remain now if 13.07, that is 1.1307. Now for year number 1, it will be 1218. Obviously, at the beginning accounts receivable at the for year number 1, and this will again be multiplied by 1.1307. This will give 1377.19. This becomes the same amount, the beginning 1377.19, and when you multiply, this will be 1557.19. So that's how we calculate the beginning and ending with the given growth rate. And now they ask us, why do the amounts of ending account receivable using the growth rate from requirement D differ from those using the growth rate for this requirement? So the difference in growth rates between the two requirements can be attributed to the distinct pattern of accounts receivable growth observed, specifically the upward and downward sawtooth patterns. Now, this pattern is characterized by periods of increasing accounts receivable followed by return to lower levels, creating a jagged upward trend. So, in this context, an upward sawtooth indicates that after a period of increase, account receivable experiences significant growth in subsequent periods. Conversely, a downward sawtooth pattern involves periods where accounts decrease receivable decreases, followed by a recovery and a further increase, creating a jagged downward trend. So this pattern shows a period of increased receivable growth following a decrease. You can see that account receivable increased by 12% during the year 4, and this indicates downward sawtooth pattern where the growth in accounts receivable is slower or reduced compared to the previous period. So this period shows a decrease or a lower rate of growth. Accounts receivable increased by 13.87% during year 5, and this reflects an upward sawtooth pattern where the growth rate of the account receivable is higher, indicating a period of recovery or stronger growth following the previous decrease. The compound annual growth rate calculations for different periods can be affected by these sawtooth patterns. The ending account receivable date falls within a downward sawtooth pattern, which might show a lower growth rate due to reduced increases or slower recovery. An upward sawtooth pattern may exhibit a higher growth rate due to stronger increases in receivables. So the sawtooth pattern cause fluctuations in the growth rates, leading to differences in the cost compounded annual growth rate calculations. For example, if account receivable experiences slower growth rate in 1 year, downward sawtooth, followed by a period of stronger growth, upward sawtooth. So the compound annual growth rate calculated over these periods will reflect these fluctuations, resulting in different growth rates as you can see in these calculations. So these patterns impact the overall growth rates calculated, leading to variations in the compound annual growth and highlighting the importance of considering these fluctuations when analyzing financial metrics. Okay. We still continue with the exercise and we go to part F. And now we have to compute the accounts receivable turnover for 2015 by dividing sales by the balance in accounts receivable at the end of 2015 instead of using average account receivable. Use this accounts receivable turnover ratio to compute the projected balance in accounts receivable at the end of year 1 through 5. Also compute the percentage change in accounts receivable between the year ends for year 1 through 5. Okay. So we will have the same sales that we have the sales that we have over here, and we can just copy it down. Oh, so this is the sales, and the accounts receivable turnover that they want to take is year 1 ending account receivable. First of all, let us talk about the account receivable turnover. And the account receivable turnover based on year end accounts receivable balance. Now, if you can recall, the sales for 2015 was 4448 divided by the by the account receivable at the end of year number 2015, that is 1218, and this is equal to 3.65. So the turnover is 3.65 for all the years. Now for the beginning, obviously it was 1218, so we have 1218, and for the end of the year ending account receivable, we have the sales for year number 1, that is 5026.24 divided by average accounts receivable, that means this is 3.65 divided by 2, and from this we are going to subtract the beginning account receivable, that is 1218, and this will be equal to 1534.68. Okay, now once we have this, we can now have the average, that is 1534.68 0.68 minus 1218, the beginning account receivable, and divided by 1218 again the beginning, and this is equal to change of 26%. And the average is obviously the total of the two and divided by 2 again, and um, we need not to make the calculations for the average this time. Okay, and then for now the ending account receivable for year number 1 will be the beginning account receivable 1534.68 divided by, we calculate 1575.85, and this will be 2.68%. This will be now 1575.85, and the ending is 1936.05, and the change is 23.05%. This will be once again 1936.05, and this will be 2032.79, and this is 4.83%. And finally 2032.79, 2455.39, and this is 20.79%. Okay. Next we go to a new exercise, that is smoothing changes in inventories. Now, Barnes and Noble sells books, magazine, music, and videos through retail stores and online. For a retailer like Barnes and Noble, inventory is a critical element of the business, and it is necessary to carry a wide array of titles. Inventories constitute the largest asset on Barnes and Noble's balance sheet, totaling 1293 million at the end of year number 2015 and 1235 at the end of 2014. Assume that in 2015 sales total 6070 million and cost of sales is 4197. So first of all we have to compute the inventory turnover ratio. So the same as we have done the account receivable turnover. So the inventory turnover ratio is cost of sales for the year 2015, and that was 4197, and this is divided by the average inventory, and the average inventory is 1293 plus 1295, 1235. Okay, so 1293 plus 1235, and average divided by 2, so this is equal to 3.32. So the inventory turnover will be 3.32 for all the years. Okay, and the cost of goods sold, as it is given over here as compounded annual growth rate of 11.6%. So for the cost of goods sold for the year number 1, year number 2015 was 4197. So 4197 times 1.116, and this will be equal to 4683.85. Once again, the ending inventory of 2015 will be the beginning inventory of year number 1, and that is 1293. And we will calculate the same way the end of the year inventory, that is cost of the goods sold at year number 1, and that is 4683.85, divided by average inventory, that is 3.32 divided by 2, minus beginning inventory of 1293. So the ending inventory at the end of year number 1 will be 1528.25, and the increase is ending minus beginning divided by beginning, that is 18.19%. The average, we can simply add the two, beginning plus ending divided by 2, that is 1410.62. We can calculate the sales in the same way. We will simply multiply this by 1.116, and that will give us 5227.18, 5833.53, 6510.22, and 7265.41. Now the ending becomes the beginning, 1528.25, and this will be 1620.26, and this is 6.02%. Average, simply ending plus beginning divided by 2, that is 1574.26, and the ending becomes beginning 1620.26, and this is 1893.48. This is 16.86%, and this is going to be 1756.87. The beginning is 1893.48, and this is 2027.86, and this will be 7.10%. Once again, this will be 2027.86, and this will be 2348.35, and this is 15.80%. This will be 1960.67 and 2188.10. So so that's how we calculate, we are going to make these calculations. So we have done part A and part B. This was part A, when we calculated the inventory turnover, and this is part B as such, and we go to part C now. Barnes and Noble sell okay, part C, the changes in inventories in requirement B display the sawtooth pattern. Smooth the changes in the inventory forecast between 2015 and year 5 using the compound annual growth rate in inventories between the end of 2015 and the end of year plus 5 implied by the projections in requirement B. Does this pattern of growth seems more reasonable? We will look into it. So first of all, we are going to look into the compound annual growth rate, and you can see it was 2348, the ending inventory 2348, compound annual growth rate will be 2348.35 divided by the beginning inventory of year number 1, that is 1293. And this is for a period of 5 years to the power 1/5 minus 1. So this is equal to, this will, if we solve, this will be equal to 12.68%. So if it is 12.68, so it will be 1.1268, 1.1268. Okay. And if we can see that we have the beginning inventory of 1293, so 1293 1293 times the compound annual growth rate. This will give us the ending inventory of 1456.95. This becomes the beginning 56.95, and then this will be 1641.69, 1641.69, and this will be 1849.86, 1849.86. This will be 2084.42, 2084.42, and this will be 2348.73. So these smoothened inventory forecasts more closely match the assumptions of smooth growth in sales and cost of goods sold, as you can see over here now. Part D. Now, suppose that instead of following the smoothing approach in requirement C, you use the rate of growth in inventory during 2015 to project the future inventory balance at the end of year 1 through year number 5. Use these projections to compute the implied inventory turnover rates. Does this pattern of growth and efficiency in inventory for Barnes and Noble seem reasonable? And we have to explain. Okay, so when we for the first of all, we are going to look into the ending inventory, and for the ending inventory, you can see that the inventory has actually increased from how much was in 2014. In 2014, it was 1235 million. So 1235, and how much was at the beginning? 1293. So 1293 divided by 1235 to the power 1, because the growth, this is only for 1 year, minus 1, and this is equal to 4.7%. So this is 4.7%. That means 1.047, or you can say, so 1.047, and we have to multiply this by the beginning inventory, and that was 1293. So 1293 times 1.047, and that is 1353.77. Now this becomes the ending, becomes the beginning. So 1353.77, 1417.40. So 1417.40.1047, 1484.02, 1484.02, 1.047, 1553.76, and 1.047. This is 1626.79. Now, so that is how we calculate the ending inventory. And finally, we calculate the implied turnover, and for this we will need the cost of goods sold, and the cost of goods sold was given here. Let me copy it down. And this will be divided by the average, that is beginning plus ending divided by 2, 1293 plus 1293 plus 1353 53.77 and divided by 2. This will be equal to 1323.39, and when we divide, this will be equal to 3.54. So the inventory turnover for year number 1 is 3.54. For year 2, again 1357 plus 1417 average, divided by 2. This will give us 1385.58, and this will be equal to 3.77. Then 5833 once again divided by the average in inventory beginning plus ending divided by 2, then that is equal to 1450.71, that is 4.02. Then 6510 divided by 1518.89, that is 4.29. And finally 1590.28, and that is 4.57. So this completes the third video on forecasting financial statements. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.